Have you ever stopped to think about financial systems built on, well, radically different principles than what most of us use daily? Today, we're doing a deep dive into exactly that, Islamic finance. Our mission here is to really unpack its core ideas, get a handle on the key prohibitions, and explore the unique financial tools it uses. We're going to distill the key insights from our sources for you.
And it's a fascinating topic because, while the philosophy behind it goes back maybe 1,400 years, its modern form, its global presence, that's actually quite recent. We've seen huge growth really since the 1970s. And today, there's a very significant amount of assets managed under these specific rules.
Okay, let's unpack this then. What is Islamic finance at its heart? Where did it really originate?
Fundamentally, it's about applying Islamic law, Sharia law, to finance. Simple as that, really. The main sources are the Quran and the sayings and practices of the Prophet Muhammad. Now, the modern version, the one we see today, that really kicked off in the 1970s, you had the first Islamic banks launching in Saudi Arabia, the UAE, and then by the 90s, places like Bahrain and Malaysia really emerged as sort of global hubs for this. And just to give you a sense of scale, current estimates suggest around maybe $1 trillion in assets are managed under these rules globally.
$1 trillion, wow. Okay, so in a financial context, what are the key principles Sharia emphasizes? You mentioned this idea of justice, partnership.
Absolutely. Those are central, justice and partnership. So the core principles say, first, wealth has to come from legitimate trade and, crucially, asset-based investment. It explicitly forbids using money just to make more money, without an underlying asset or shared risk. That's key. And there's more. Investment should also ideally bring some social or ethical benefit to society, not just pure profit. Risk must be shared. That's non-negotiable. And of course, any harmful activities, Haram activities, must be avoided completely.
Right. And this is where it gets really interesting, isn't it? These specific activities that are prohibited, the haram ones.
Exactly. Understanding the prohibitions is crucial. So number one, the big one, is charging and receiving interest, known as Riba. The reasoning here is profound. It goes against those core ideas of risk sharing, partnership, justice. Because think about it, a conventional lender charges interest regardless of how the actual business or asset performs. Sharia sees that as unfair. It's making money purely from money, detached from real economic activity. And this prohibition extends further. It also means you generally can't invest in companies that rely too heavily on conventional interest-based debt.
Oh, interesting. Is there a specific level?
Yeah, there's a common guideline. Generally, debt shouldn't total more than, say, 33% of the company's average market value over the last year. It's a kind of benchmark used by many Sharia scholars to gauge if a company's finances are, overly reliant on interest.
Got it. Okay. What else is prohibited?
Well, next up are investments in businesses considered haram. So that means no investing in alcohol, gambling, pork products, pornography, drugs, basically anything Sharia deems unlawful or undesirable. Pretty clear cut, usually.
Makes sense. What about risk itself?
Ah, yes. There's a prohibition against excessive uncertainty, speculation, and extreme risk. It's called gharar. This is seen as being too much like gambling. So speculating wildly on futures or options markets, for example, that would likely be out.
But what about things like insurance? Isn't that about uncertainty?
Good question. Mutual insurance is generally permitted. The key difference is that it relates to reasonable, unavoidable business risk. It's based on shared responsibility. Members contribute to a mutual fund for security, for collective protection, not primarily for speculative profit.
Okay, that distinction is important. Any other major prohibitions?
One more key area is uncertainty about the actual subject matter in terms of contracts. This includes, for instance, a ban on selling something you don't actually own yet.
How does that work for manufacturing, where the product doesn't exist when the contract is made?
Right, there's a specific technique for that. It's quite clever. Essentially, a manufacturer can promise to make a specific product under agreed specs for a set price by a fixed date. The bank might commission this manufacturer, taking on the risk. Then, it sells the finished goods to the customer, adding a reasonable, agreed-upon profit. Because transactions need this level of clarity and definition, it generally rules out things like complex derivatives, conventional short selling, or sales on margin. Too much uncertainty, you see.
Wow. Listening to all that, what really stands out is how fundamentally different the approach to risk and ownership is compared to, conventional finance. What strikes you most about these differences?
It really is a different mindset, isn't it? Mm-hmm. For me, what's profound is that these aren't just arbitrary rules. They stem from a deep ethical concern, trying to avoid injustice, avoiding situations where one party gets unfairly enriched or where risk isn't shared equitably. And this naturally leads to a very important question many people have.
Which is?
If you can't charge interest, how on earth do Islamic banks actually make money? How do they provide services?
Exactly. That's the million-dollar question, or maybe the trillion-dollar question, given the assets involved. If interest is out, how do Islamic financial institutions generate profit and operate?
Right. It requires a completely different toolkit. Profits come mainly from profit sharing on the assets financed or through fees charged for specific services. The absolute core idea is, when finance is provided, the financier must share in the risk of the underlying activity or asset. If they don't share the risk, any return above the principal looks and feels like interest, which is forbidden.
Okay, so let's get into those tools. What do these Shariah-compliant instruments actually look like?
Sure. Let's start with Murabaha. Think of it as a form of trade credit, used often for buying assets.
Yeah.
Here's how it works. The bank buys an item the customer wants. Then the bank sells it to the customer, often on deferred payment terms, at a price that includes an agreed fixed markup. That markup is the bank's profit. And crucially, the bank takes real business risk. If the customer, for some reason, doesn't end up taking the goods after the bank has bought them, the bank can't just increase the markup to cover its costs. The price was fixed. And the goods, which still belong to the bank at that point, might have lost value. So it's genuine trade, genuine risk.
Okay, that makes sense. What's next?
Then you have Ijara. This is basically a lease finance agreement. The bank buys an asset for a customer and then leases it back to them over a set period for an agreed rental amount. Ownership stays with the bank during the lease-in period. The rental payments allow the bank to recover its capital cost, plus make a profit margin. We see this used a lot in the real world. Emirates Airlines, for example, frequently uses Ijara to finance its aircraft fleet expansion.
Ah, I heard of that.
And another big example, back in 2003, HSBC became the first major UK bank to offer Shariah-compliant mortgages. They structured them using an Ijara model. So the bank technically buys the house, leases it to the customer, and the customer's payments cover rent, insurance, and gradually pay off the original sum borrowed. At the end of the term, title transfers to the customer.
Fascinating. So like rent to own almost, but structured compliantly. What else?
There's Murabaha. This one is more like equity finance or investment management. In a Murabaha setup, the bank provides the capital, and the borrower, who has the expertise, invests it in a business venture. Profits, if any, are shared according to a ratio they agreed on beforehand. But here's the key. There's no guarantee of profit or even that the bank will get its original capital back. The bank takes on significant investment risk. In practice, you often see this used as an investment product, where the customer acts as the capital provider, depositing funds, and the bank acts as the manager, mudarib, investing those funds.
So the bank acts almost like a fund manager in that case.
Sort of, yes, managing the investment according to Sharia principles. Then there's Musharaka. This is essentially a joint venture or investment partnership. Here, both parties contribute capital to a project or venture. They also typically both contribute expertise or management. Profits are shared based on a pre-agreed ratio, which can reflect both capital and effort. Losses, however, are usually shared based on the proportion of capital each party put in. Interestingly, banks sometimes tend to use musharaka less often than, say, Murabaha or Ijara, maybe because it requires them to be more actively involved, more hands-on in the venture itself.
Right, requires more direct partnership. Okay, one more you mentioned, sukuk.
Yes, sukuk. These are often referred to as Islamic bonds, but that's a bit simplistic. Unlike conventional bonds, sukuk cannot bear interest. That's the fundamental rule. Instead, sukuk holders must have a proprietary interest, a kind of ownership share in the specific assets being financed by the sukuk issuance. Their return isn't interest. It's a share of the actual income generated by those underlying assets. Now, an important distinction often arises. Most sukuk are asset-based rather than asset-backed.
What's the difference there? That sounds quite technical.
It is, but it's crucial for investors. Asset-based generally means the sukuk holders have claim to the income stream from the assets, but not necessarily direct ownership or claim over the physical assets themselves if things go wrong. Asset-backed would be closer to a conventional secured bond, where you have recourse to the actual underlying collateral. So asset-based sukuk can carry different, sometimes higher risks in a default scenario compared to what an investor might assume from the term bond.
Okay, that's a really key nuance. So how are they typically structured?
Common structures might use principles like ijara, leasing, or a musharaka, partnership. For example, an entity issues sukuk, uses the funds to buy property, leases that property out to generate rental income, and then distributes that rental income to the sukuk holders as their profit share. Across all these instruments, Murabaha, Ijara, Murabah, Mushraka, Sukuk, the critical point, the underlying theme is this. While the cash flows might sometimes look similar on the surface to conventional finance.
Like regular payments.
Exactly. But the basis for the return is fundamentally different. It's tied to a real asset transaction, a lease, a partnership, a share in actual profits or revenues. It's not based on just lending money and charging interest. The whole intention, the whole architecture, is designed to avoid what Sharia sees as potential injustice, asymmetric risk, where one party takes all the risk, moral hazard, and unfair enrichment.
What's fascinating here really is that fundamental shift you described, moving away from just money-on-money returns towards asset-based risk-sharing models. It sounds like proponents would argue this creates a more stable system.
That's definitely a claim advocates make. They argue that Islamic finance, because it inherently prohibits excessive speculation, gharar, and interest, riba, and because it mandates risk sharing. Well, it was somewhat insulated from some aspects of the recent global financial crises.
Insulated but not immune, I assume.
Precisely. No system is risk-free. But the argument is that when the financier has skin in the game, when they share in the actual risk of the underlying venture, it naturally encourages more prudence, more careful assessment of investments, less gambling, more genuine partnership.
Okay, that makes sense. But with all these complex principles and instruments, who actually ensures compliance? Who makes sure a bank or product is genuinely following Sharia law?
That's the job of the Sharia board. This is a really crucial component of any Islamic financial institution. It's essentially a committee made up of qualified Islamic scholars who are experts in Sharia, particularly its application to finance, fiqh muamalat.
And does every institution have the same board?
No, typically each institution has its own independent Sharia board. This can sometimes lead to variations in rulings between institutions. Their main functions are, first, to review and approve any new products or services before they are offered to the public, to ensure they comply. And second, they often provide ongoing oversight and might give judgments on specific individual transactions or customer proposals if there are questions about permissibility. They also play a vital role in innovation, helping to develop new financial instruments and products that meet market needs while still adhering strictly to those core Sharia principles. It shows the system isn't static, it evolves.
So you have these strong principles, these specific instruments, and this dedicated oversight body. But are there still challenges? What are the big issues or developments happening now in Islamic finance?
Well, probably the main challenge or complexity right now is the one we touched on, the lack of a single, universally recognized worldwide body setting definitive standards for Sharia compliance.
So no single global authority.
Exactly. Because Sharia interpretation can have nuances, and because each institution often relies on its own board, you can get situations where one bank's board approves a particular structure or transaction, while another bank's board might reject it.
Which could create uncertainty, I imagine.
It can. There's a potential risk, sometimes called Sharia risk, that a contract considered valid by one board might face challenges or even be declared invalid under a different interpretation or jurisdiction.
Are there moves to fix this, to create more consistency?
Oh, absolutely. There are significant efforts underway. Malaysia, for instance, is the world's largest market for sukuk, and they have a central Sharia advisory council at their central bank that promotes consistency within Malaysia. And then there's the Accounting and Auditing Organization for Islamic Financial Institutions, AAOIFI, based in Bahrain.
AAIFI.
Yes, AAOIFI. They're doing really important work developing accounting, auditing, governance, and Sharia standards for the industry globally. They have broad support, something like 200 members from 45 countries, including central banks and major financial institutions. Their standards are actually mandatory in some jurisdictions like Bahrain, the Dubai International Financial Center, Jordan, Qatar, Sudan, and they serve as official guidelines in many others, including Indonesia, Malaysia, Pakistan, Saudi Arabia, South Africa, and even influencing practice in places like Australia.
So progress is being made towards standardization.
Definitely. There is a clear trend towards greater harmonization. However, given the nature of Sharia interpretation and national legal systems, it's likely that some differences between jurisdictions will probably remain for the foreseeable future.
This has been incredibly insightful. We've really covered a lot of ground from the foundational principles of justice and risk sharing in Islamic finance through the specific prohibitions like riba and gharar, exploring those unique instruments like Murabaha, Ijara, and Sukuk, and understanding the vital role of the Sharia board.
And it all comes back to that core intention, really. structuring finance in a way that aims to avoid injustice, avoid asymmetric risk, prevent moral hazard, and stop unfair enrichment. It achieves this by fundamentally linking financial returns to real economic activity, to asset transactions, and to the principle of shared risk, rather than just the lending of money for interest.
It makes you think. Considering that emphasis on risk sharing, on potential social benefit, on tying finance to tangible assets, how might our broader global financial system look? How might it evolve if some of these principles were more widely considered or even adopted? It certainly leaves us with some things to ponder. What new questions does this deep dive raise for you?